Hi, I'm Jeff Lovell, a staff accountant with AA Accounting. Today I'd like to talk about the tax rules related to deducting casualty losses. To be deductible, a casualty loss must be from the damage, destruction, or loss of property resulting from an identifiable event that is sudden, unexpected, or unusual. Qualified examples are accidents, natural disasters, terrorist attacks, vandalism, and theft. You cannot deduct damage that's caused by a pet, damage that's done on purpose by you, like deliberately wrecking your car, burning your own house down, or committing fraud, lost property, damage from termites or moths, or natural wear and tear. You cannot deduct as a theft losses of property from when your spouse leaves you, or the reduction in value of stock you own because of a fraud committed by the company. You must file a claim for any insured item in order to receive a deduction. If the insurance reimbursement is more than what you originally paid for the item, the excess amount is considered taxable income. The amount you can actually deduct on your tax return is usually significantly less than your actual economic loss. This is because of a rule that forces you to consider the lesser of what you originally paid for the item, or your actual economic loss, minus your insurance reimbursement when figuring the deductible loss. You also must consider each loss event separately, and you deduct a $100 floor for each event, and all of your losses total for the year have to be reduced by 10% of your adjusted gross income. This means you can only take a deduction if your losses are over 10% of your income, which is unusual. Let's consider the comprehensive example of Bob. In 2015, Bob had a rough year. His AGI for the year is $70,000. In March, a storm completely destroys his house, and in October, his car is stolen along with his laptop. His house and car were insured, but his laptop was not. In the table on the screen, you can see his cost basis, i.e., what he originally paid for each item, his actual economic loss, which would be what the item was worth when it was destroyed or stolen, versus what it's worth now, 0, his insurance reimbursement, and then his net casualty loss. As you can see, Bob is actually out about $129,000 for the year. On Bob's tax return, he will only be able to deduct $3,500. This is because of the rule that says we must consider the lesser of what he originally paid for the house versus the actual loss. Therefore, we can only consider the $97,000 Bob paid for his house years ago versus the insurance reimbursement he receives now. As a result, his deductible loss for the house is only $9,000 minus his $100 floor. The car and the laptop both were lost in a single event, so they share a $100 floor. This leaves the deductible loss at $10,500, and since he made $70,000, he can only deduct $3,500, the amount that exceeds 10% of his income. If you have questions about the deductions covered in this video, or other tax or accounting questions, call the experts at AA Accounting. Call us today to schedule an appointment to discuss your tax situation. We can help.